Many manufacturing operations look healthy on their final financial statements, obscuring the fact that they are losing cash on the factory floor. This disconnect happens because the accounting systems designed to measure operational health often mask operational realities. Consider a standard control scenario. A company produces two similar items. Product A is a high-volume workhorse, while Product B is a specialized low-volume alternative. This table calculates costs using a traditional volume-based approach. Both items appear equally successful, profiting $17.81 per unit. But look at the middle rows. The $20,000 in overhead was simply divided based on the direct labor volume. This is a traditional volume-based costing system. It accumulates all indirect overhead into a single cost pool and then spreads it across all end products using a single metric, like labor hours. This math relies on assumptions from an older era. Decades ago, direct human labor was the primary driver of production costs, and shared indirect overhead, things like utilities and plant maintenance, was minimal. Applying that volume-centric math to a modern manufacturing floor creates a deceptive sense of uniform profitability, masking severe internal inefficiencies. Management accountants refer to this inaccurate averaging of indirect costs as peanut butter costing. The system takes a thick layer of overhead and smears it evenly across everything the factory produces. That smooth spread fails in modern facilities. Due to rapid technological advances and automation, direct labor has shrunk, while overhead dominates total manufacturing costs. Relying on volume to assign these massive indirect costs triggers a financial anomaly known as product cost cross-subsidization. Because the math is tied purely to production volume, the simple, high-volume products absorb the vast majority of the overhead burden, leaving them systematically overcosted. Conversely, complex, low-volume products receive a tiny fraction of that burden. This systematically undercosts them, hiding the disproportionate administrative and technical resources they actually drain from the facility. Relying on traditional volume metrics tricks management into subsidizing inefficient, complex products using the profit margins of simpler, high-volume workhorses. The structural solution to the cross-subsidy trap is activity-based costing, or ABC. ABC abandons the single volume-based rate in favor of a causal two-stage allocation architecture. The top tier of this diagram outlines the starting point. Instead of lumping accounts together, accountants identify specific resources that constitute overhead. In the first stage of allocation, the system maps these resources into operational buckets called activity cost pools. To draw those connections, the system uses resource drivers. These are measurable cause and effect data points that track exactly how much of a resource an activity actually consumes. For example, you cannot trace a general utility bill directly to a single metal widget, but you can use square footage as a resource driver to accurately allocate a percentage of that utility cost to the facility's machining department. This first stage successfully translates passive accounting ledger data into an active map of organizational operations. The activities captured in these cost pools exist within a strict hierarchy based on the level of the production process where they take place. Unit-level activities are costs incurred for every single item produced, like running a drill press. At the other end are facility-sustaining activities, like plant security, which concern overall operations and cannot be traced to specific products. The most significant disruptor of traditional math lies in the middle, batch-level activities. A primary example is the physical setup of a total setup cost is identical, but the per-unit burden changes drastically based on the batch size. Moving to the bottom half of the architecture diagram, the system now has fully funded activity cost pools. The second stage allocation drains these pools into the final cost objects, the products themselves. This is done using activity drivers, which are specific metrics, like the number of line setups required, measuring the actual demands a specific product places on an activity. By tracing costs through this two-stage causal chain, ABC replaces arbitrary volume spreading with a precise reflection of operational reality. Let's return to our initial scenario, where both Product A and Product B seemingly generated a $17.81 profit. When we run that $20,000 overhead block through an ABC analysis, the data reveals that the overhead consists almost entirely of batch-level production line setup costs. Because the factory processes them in equal batches throughout the month, Product A and Product B require identical setup times. The recalculated table drops the 10-to-1 volume ratio, allocating overhead by a 50-50 setup split, 10,000 to Product A, 10,000 to Product B. Isolated to a 100-unit volume, Product B's profit evaporates into a $64 loss per unit. The data shows that the high-volume Product A had been heavily subsidizing the frequent setup requirements of the low-volume Product B. Without activity-based costing, the company believed it was thriving while losing money on every single unit of Product B it sold. Discovering a loss is only the diagnostic phase. The strategic response is activity-based management, which links product costing to the continuous improvement of factory processes. The design of this system relies on process value analysis. This requires management to evaluate the newly mapped activity pools to determine which activities actually matter to the end product. A value-adding activity contributes directly to customer satisfaction or a core requirement of the entity. If it is omitted, the quantity or quality of the output drops. A non-value-adding activity does not make that contribution. Moving components, storing excessive inventory, and waiting for the next operating step are resource drains. Once exposed by ABC, these become targets for redesign or elimination. Warning tone. This level of insight into a company's operations comes with a high price tag. The primary disadvantage of activity-based costing is the cost of implementation. It requires a complex accounting system and dedicated personnel to track these unique resource drivers outside the standard general ledger. If a company has very low fixed costs or produces a single uniform product with no diversity, the traditional volume-based approach is still sufficient. The insight gained would not outweigh the cost to track it. For modern organizations navigating high overhead and diverse product lines, activity-based costing provides the only mathematically precise lens through which to view the true cost of doing business.